The foreign exchange market, often called Forex or FX, is the largest financial market in the world. It is a decentralized global marketplace where currencies are traded. Think of it as the central hub that facilitates international trade and investment. If a European company needs to buy supplies from the United States, it must exchange euros for US dollars, and this transaction happens in the Forex market. Because of its immense scale and constant activity, the Forex market is incredibly sensitive to global events. Economic data, central bank decisions, and most powerfully, geopolitical tensions can send significant ripples through currency values, creating both risk and opportunity for traders and investors alike. This sensitivity is crucial because currency fluctuations affect everyone, not just traders. The price you pay for imported goods, the cost of traveling abroad, and the profitability of multinational corporations are all influenced by exchange rates. When a major conflict erupts, it introduces a massive dose of uncertainty into the global system. Investors, driven by a primal instinct to protect their capital, rush to move their money out of what they perceive as risky assets and into so-called safe havens. This flight to safety dramatically alters the supply and demand for different currencies, leading to sharp and sometimes unpredictable price swings that can define market trends for weeks or months. Historically, geopolitical stress, particularly conflicts in the Middle East, has followed a predictable script in the Forex market. Tensions rise, oil prices spike due to fears of supply disruption, and investors flock to the perceived safety of the US dollar. This classic risk-off reaction has made the dollar the world's primary safe haven currency for decades. However, the recent escalation between Israel and Iran in June 2025 is challenging this long-held assumption. While parts of the old script are playing out, the market's reaction, especially concerning the US dollar, is showing signs of a significant and noteworthy deviation from historical precedent. Understanding this dynamic is essential for navigating today's complex financial landscape. The Forex market acts as a real-time barometer of global sentiment, reflecting the collective hopes and fears of millions of market participants. It tells a story not just about economic health, but also about political stability and the shifting sands of global power. The ongoing conflict is a stark reminder that in an interconnected world, a regional crisis can have far-reaching financial consequences, forcing market watchers to reassess old certainties and adapt to a new and evolving reality where traditional safe havens may no longer offer the same degree of protection as they once did. The month of June 2025 has been marked by a severe and dangerous escalation in the long-simmering conflict between Israel and Iran. The situation rapidly intensified as both nations engaged in direct military confrontations, a development that has captured the world's attention and sent shockwaves through financial markets. Reports confirmed a series of Israeli missile strikes targeting key Iranian nuclear facilities and high-ranking military officials. Among the most significant events was the claimed killing of Iran's armed forces intelligence chief, a move that signaled a serious ratcheting up of hostilities. These actions were not left unanswered, as Iran launched its own retaliatory strikes against strategic Israeli targets. In response, Iran's military reportedly struck Israel's largest oil refinery located in Haifa Bay, a direct hit on the nation's critical energy infrastructure. This specific act of retaliation underscored the potential for the conflict to disrupt vital energy supplies flowing from the region. The human cost has also been severe, with reports indicating over 200 deaths resulting from the Israeli attacks. The tit-for-tat nature of these exchanges has created a highly volatile and unpredictable environment, with each new headline adding to the market's anxiety. The conflict has moved beyond proxy warfare and into direct state-on-state military action, a threshold that carries immense geopolitical risk. Amidst the escalating military actions, diplomatic efforts have so far appeared to be faltering. US President Donald Trump publicly issued a call for peace, stating that many calls and meetings now taking place, which offered a brief glimmer of hope for de-escalation. However, this optimism was quickly tempered by his early departure from the G7 summit, a move that analysts interpreted as a reduction in the likelihood of an immediate, coordinated diplomatic breakthrough. The lack of a clear off-ramp for the conflict has left investors on edge, forcing them to price in a higher probability of a prolonged and potentially wider regional confrontation that could draw in other global powers. The sequence of events, from targeted assassinations to strikes on energy infrastructure, has created a textbook risk-off scenario. This is the kind of geopolitical crisis that typically sends investors scrambling for safety. The direct military engagement between two of the Middle East's most powerful nations represents the most significant flare-up in years, and its implications for global stability and energy security are profound. The market's immediate reaction has been a frantic search for assets that can weather the storm, leading to dramatic price movements in commodities and currencies as traders try to position themselves for what may come next. As tensions flared between Israel and Iran, the commodity markets reacted with textbook precision. The most immediate and dramatic impact was seen in the price of crude oil, with Iran striking a major Israeli refinery and the broader conflict threatening key shipping lanes in the Strait of Hormuz. Fears of a significant supply disruption gripped the market. West Texas Intermediate crude oil prices surged by over 7% on the day of the most intense strikes and saw a weekly gain of over 10% for the week ending June 14, 2025. This sharp spike reflected the market's deep-seated anxiety that the conflict could spiral, choking off a vital portion of the world's energy supply. Simultaneously, the precious metal gold, the ultimate traditional safe haven, lived up to its reputation. Investors, seeking to shield their wealth from the turmoil, poured capital into gold, driving its price to a two-month high above $3,450 per ounce. On the day of the major retaliatory strikes, gold rose a solid 1.5%, confirming its status as the go-to asset in times of extreme geopolitical uncertainty. This flight to gold is a classic market reaction, as the metal is seen as a store of value that is independent of any single government or currency, and tends to perform well when faith in other financial assets wavers. However, the most fascinating part of the market's reaction has been the performance of the US dollar. Historically, the dollar has shared the safe haven stage with gold, often strengthening significantly during Middle East conflicts. This time, its reaction has been conspicuously muted. While the dollar index did see a minor uptick of about 0.25% during the peak escalation, it quickly faded and continued to trade at depressed levels around 98.00. This lackluster performance stands in stark contrast to past crises, such as the 2006 Israel-Lebanon war, when the dollar rallied over 2%, signaling a potential shift in its global standing. Several factors appear to be tarnishing the dollar's safe haven appeal. The currency was already weak, having depreciated 10% year-to-date, and sitting at a 3.5-year low before the conflict began. Investors have grown wary due to President Trump's unorthodox policies and rising concerns over the United States' fiscal health. This pre-existing weakness was compounded by underwhelming domestic economic data, including a sharp fall in the June Empire State Manufacturing Index. As a result, the classic dollar smile theory, which posits the dollar strengthens in times of both global risk and strong US growth, is being severely tested, with its risk-off rally proving to be shallow and short-lived. The US dollar's surprising weakness has created a divergent and complex picture across the broader Forex market. Instead of a uniform flight to the dollar, traders have shown varied preferences, leading to distinct performances among other major currencies. The euro, for instance, has managed to press higher against the dollar, with the euro-dollar pair pushing toward the 1.1600 level and setting new highs for 2025. This strength is less about newfound confidence in the eurozone and more a direct consequence of the broad-based selling pressure on the greenback. The dollar's inability to capitalize on the risk-off mood has allowed the euro to continue its bullish trend. Other traditional safe haven currencies, like the Japanese yen and the Swiss franc, have had mixed reactions. While one would expect both to strengthen significantly, the dollar has actually held its ground against the yen, with the dollar-yen pair remaining range-bound above 144. In contrast, the dollar has weakened notably against the Swiss franc, which has performed its safe haven role more effectively. Meanwhile, commodity-linked currencies like the Australian, Canadian, and New Zealand dollars, which typically suffer in risk-off environments, have paradoxically gained against the US dollar, supported in part by the dollar's overarching weakness, and in Australia's case, positive economic data from China. Looking ahead, the market's focus is split between the volatile geopolitical situation in the Middle East and a critical upcoming calendar of economic events. Any new headline, whether of further military action or a potential diplomatic breakthrough, will continue to inject volatility into the market. At the same time, all eyes are on the central banks. The US Federal Reserve is scheduled to announce its interest rate decision and release its revised economic projections today, June 18th. This announcement will be scrutinized for clues on the Fed's thinking and could either exacerbate the dollar's weakness or provide it with a much-needed lifeline. Ultimately, the path forward for the Forex market is fraught with uncertainty. The muted reaction of the US dollar during a major geopolitical crisis suggests a potential structural shift is underway, where investors are diversifying their safe haven holdings away from dollar-denominated assets. Decisions from the Fed, alongside upcoming US retail sales data and policy announcements from the Bank of Japan, will be pivotal. Traders and investors must remain nimble, as the interplay between escalating Mideast tensions and key central bank policies will likely dictate currency trends for the remainder of the month and beyond. If you found this analysis helpful and want to stay updated on the latest market developments, don't forget to subscribe to our channel and hit the notification bell. Your support helps us bring you more timely insights on global finance.